Most investing portfolios are built around three pillars. You have equities, you have fixed income, and in Canada, a lot of people have real estate. Many of our clients, generally sophisticated Canadian business owners, are adding a fourth. It's not hype, kind of boring. It's not for chasing returns, but what it gives you is stability. It gives you tax efficiency and gives you control over your money. It's called participating whole life insurance. There's protection, but it's not protection just by itself. This is a structured asset when done correctly. Hi, my name is Laurent Munier. I'm a partner and advisor here at Safe Pacific Financial, and over the last 15 years, we've worked with incorporated professionals and high-income Canadians who are not so much concerned with chasing the highest returns, but they're more focused on protecting what they've already built. In today's video, I'm going to break it down. I'm going to break down why some investors now categorize these whole life policies as a separate asset class. We'll talk about the structural characteristics that separate it from traditional investments, especially fixed income, and how your ownership, how the corporate ownership of it can enhance your tax efficiency. And then really, the last little bit will be about why the insurance company's structure itself matters. So talking about mutual companies versus stock companies. And this does matter more than most people realize. So this takes a mindset shift, going from insurance is an expense to insurance is a strategic asset. Now, for decades, most Canadians have viewed life insurance through a very narrow lens, and I think this continues today. It was positioned as a cost, a necessary expense, a check that you write every month to protect against the unexpected, right? You pay the premiums and you hope that you don't need it anytime soon, and then the only return is when you pass away and the money goes to someone else. So that mindset makes sense, and it made sense when the insurance was purely about income replacement, which is an important thing to think about. But participating whole life insurance can be so much more. It's actually structurally different than the term policies that most people understand. When it's properly designed, especially when you've got a high income Canadian or an incorporated business owner, it does way more than provide the death benefit, which is important. So here's some things. It builds guaranteed and dividend-enhanced cash values. So the growth of the cash values inside these policies has guarantees on it, and it grows with a dividend from the insurance company's participating account. It has long-term corporate and or personal liquidity. So when you need money, your insurance policy can help you get it. It's very, very stable. It has tax advantages that you can't get anywhere else, and the policies grow. So these tax advantages help the policy grow over the long term. It also has contractual estate funding that bypasses probate when you set it up correctly. So insurance pays out quickly. Most of the insurance companies that we work with, if somebody passes away, their estate or their beneficiaries or whoever will get a check from that insurance company in like 7 to 14 days. Compared to probate, which could be 18 to 24 months. And sometimes it could be years. Like we've dealt with probate cases that are, 10 years old. Another thing that we want to talk about is the Capital Dividend Account that is created and credited when the corporate-owned insurance pays out. So in other words, these types of policies function as a financial asset with insurance characteristics. It's not just an insurance contract with a cost. So sophisticated investors don't really ask, how much does this cost? They ask, A, how much can I put into one of these? So it's a completely different question. How does this affect my balance sheet? How does this help me with my liquidity, either corporately or personally, depending on how we set it up? How does this affect my taxes? And how does this reduce tax drag over the long term? And then how does this eventually pass to my kids or to my whoever, right? How does this strengthen my estate plan and make it easier, simpler, and cleaner? This is why the language has evolved, right? The conversation isn't about buying insurance. It's about allocating a certain amount of your capital to this type of asset that delivers protection as one of the main benefits, but it also delivers all these other benefits that I've talked about and that we're going to expand on. So this mindset shift, changing from expense to asset, is really what separates the transactional buyers of insurance from somebody who's thinking about it more strategically. And then once you see how these participating whole life policies work through that lens, it really changes how you evaluate the role inside your portfolio, inside your corporation, or inside your personal estate. I've been talking about asset class. So what defines an asset class? Before we label it as an asset, what is it? So in a professional portfolio, an asset class is more than just something that you own. It's a category of where you put your money. And it's a category that behaves in a certain way, predictably, structurally, consistently over time. So institutional investors typically evaluate an asset class based on some core characteristics. Number one is it should demonstrate relatively consistent behavior across market cycles. So regardless if it's high risk or low risk or medium risk or whatever, it should behave similarly through these cycles. It has an identifiable risk and return properties. So again, different asset classes have different risk and generate different returns. It contributes to diversification inside that portfolio. So you'll have different asset classes inside the portfolio. And managing the way that you structure your asset classes in the portfolio will help to manage your volatility during downturns. So not everything goes up at the same time and not everything goes down at the same time. So you want to have different types of asset classes so that when certain things are going down, other things are going up and you can balance yourself out. Asset classes also support long-term capital preservation and your long-term plans. In other words, an asset class earns its place not by outperforming everything else, but by improving how the entire portfolio behaves and it plays its role in that portfolio. So most sophisticated Canadian portfolios are not built exclusively for maximum growth. You should have your portfolio built for probably durability, right? And this is why even very wealthy families, who have access to private equity or big real estate portfolios or growth-oriented investments, they still maintain a meaningful allocation to cash, short-term fixed income, high-grade bonds, low volatility things. Many of our clients, like our richest clients, have a ton of money in GICs. They could be invested in bigger things, but the guarantee is worth more to them than making as much money as possible. And they do this not because they expect whatever the asset class is to outperform equities, but because they value the preservation first, then the growth. And that's how you build a solid financial plan, is by making sure that your protection is there, your foundation is there, and that lets you go for the growth in such a much more stable and confident way. The preservation protects the base, and then the growth builds on that. And then this is where these participating whole life policies enter the conversation. When they're properly structured, especially if it's within some sort of corporation, like maybe your holding company, they function as the stability role. So similar to your fixed income, but with important differences. So you've got the cash value growth that's inside the policy that is not correlated to public markets. So when the stock market is going up and down, the value in your insurance policy is not. You also get the dividend participation from the insurance company's participating account. So again, the growth comes from the dividend that gets paid into these policies. It doesn't come from stocks going up and down. And then the special part of these things that's very different from other types of asset classes is the tax-deferred accumulation of cash values inside the policy. It's the tax treatment of life insurance in Canada. Another thing that makes these things so valuable and why our clients use it is because you have that access to liquidity without having to sell something, right? Because you can leverage these policies, you can get cash. And then at the very end of the day, shocker, we're all going to have an end of the day. There's estate and a capital dividend account advantage when it's inside the corporation. So there's big estate advantages to having insurance, right? The insurance pays out tax-free, either to your beneficiaries or to your corporation. And this can help to pay, especially the taxes that come on death. And it can help to fund the legacy that you want for usually people's kids. So traditional fixed income gives you the stability, but it doesn't give you all these other things. It doesn't give you tax advantage, estate transfer. You can sort of collateralize it, but you can't collateralize it anywhere close to what you can with an insurance policy. And this is why many of our high net worth Canadian families and our business owners, they see these types of whole life policies as kind of a replacement for the fixed income portion of their portfolio. It's a strategic complement that's in that stability bucket. But when you look at it through the lens of this is another asset class, you can see that it's not chasing returns, but what it does is it reinforces your whole structure. So now I promised you those 5 reasons, and we'll talk about the 5 reasons that whole life insurance, especially participating whole life insurance, acts as an asset class. So number 1 is the diversification. So how do these policies actually work? One of the defining characteristics of these participating whole life insurance policies is the structure that supports it. It's the participating part of it, the participating account. So unlike a single investment or like a really narrow focused fund, these policies are backed by large, professionally managed pools of assets that are maintained by whatever insurance company you bought the policy from. So this pool is called a participating account. And so as people put money into the cash value of their accounts, it goes into the participating account. And then you have this professional team that uses that money to generate stable long-term returns while supporting the guarantees and the dividends of the policy. So for Canadian participating policies, these accounts are usually like really broadly diversified. And so depending on the insurance company, it can include usually a combination of high quality bonds and fixed income securities. A lot of times it'll have commercial and potentially residential mortgages, or maybe they just own the whole building. And there's a lot of institutional real estate. So like office towers, shopping malls, just big real estate. Some of them have private placements or they invest in infrastructure investments. So, hey, you need to build a bridge and the province needs to borrow or needs to float a bond for $2 billion to pay for this. A lot of times it's insurance companies that are paying for that kind of stuff. Sometimes they have some allocation to equities. Usually it's pretty small, but really the purpose of this diversification, the insurance companies are not chasing short-term market performance, right? Their goal is different. Their goal is long-term, consistent stability. Because this participating account spreads the capital across multiple asset classes, the policy's performance, it's not dependent on a single type of market or a single economic cycle. So if one segment of what they're holding has volatility or dips, other parts of that participating account helps balance everything out. And again, they're thinking about these things on very long-term basis, right? Like they're buying the bonds for 10 years, 20 years, 30 years, and they're thinking, I sold this 35-year-old a participating policy, and if this 35-year-old dies like the perfect Canadian statistic at 85, this policy needs to work for 50 years. And then at the end of 50 years, you got to pay out that death benefit that's been promised and paid for, right? So this is what they're thinking about. They're not thinking about how am I going to make 20% this year? Like they're not thinking 1 year at a time. It's very different from a traditional retail investment portfolio where you might have stocks or ETFs or mutual funds or some sort of like public securities. In these participating policies, the benefits from the institutional diversification from the insurance company's balance sheet, really, this is the underlying engine that drives the cash value growth and the policy dividends. So it's supported by this type of portfolio, right? That's based on capital preservation. Like the insurance companies are trying to not lose money. It's based on stability. So they want these things to be very stable over the long term. And they want long-term compounding, right? So you make the promise today when you sell the policy, but you got to pay out that promise 30 or 40 or 50 or 60 years in the future. So you need to have that compounding to be able to pay out potentially millions of dollars that you promised on these life insurance policies. So for many high-income Canadians and for the business owners that we work with, this foundation is one of the reasons why these participating policies play like the stability role inside their broader financial strategy. So they do equities somewhere else to try to get the gains, but this is the foundation where you don't want this to mess up. So rather than relying on a single asset class, you're basically leaning on the insurance company to provide this diversified investment engine underneath your insurance policy that works behind the scenes. And they work really well. Like I have a few of these policies myself, and I love getting my insurance policy statements. The second thing we're going to talk about is the stability and the low volatility. So why does this matter, right? Why does this predictability matter? When you do have that high income and when you are a business owner and you're generating your retained earnings every year, the appeal of these types of insurance policies isn't about chasing the highest possible return. Most of our business owner clients are going to get the highest possible return from their own business. They're not going to get it from giving the money to somebody else. What they're looking for here is generally it's the stability and the peace of mind of knowing that this thing isn't going to mess up. So in traditional public markets, like in your traditional portfolio, you have your stocks, your ETFs or whatever, those things are repriced like every single minute of every single day because they're in the public markets. You can just go online and you can see the price of these things changing. You have market sentiments, you have interest rates, you have economic news, you have global events. All of these things can dramatically swing your portfolio, sometimes in like one day, either spiking the price or dropping the price. So this constant repricing creates the volatility, and that's how you make money in the markets. But that volatility creates uncertainty, and not everybody wants uncertainty. So these participating whole life policies are very different. The underlying participating account is managed by the insurance company with a very long-term perspective. So they're not reacting to short-term market movements. They want to smooth the results over time. They want to balance strong years with low years to create a steady long-term experience for the policy owners. So if you look at one of these participating account dividend that's been paid out historically, they're not going up and down by multiple percents every year, right? Like a 0.25% change in the dividend rate from an insurance company is a big deal. They're not going up by 2 or 3 or 4 or 5% in a year, and they're not going down by 2 or 3 or 4 or 5% a year. They're going up and down by percentages of percentage. The smoothing process that these insurance companies use means that the performance inside the policy is definitely less exposed to daily market swings. It's more stable over time. It's more predictable in the long-term growth. You don't have these sharp up and downs, right? The policy cash value and the dividend performance, they're way more gradual and slow on their stable trajectory. And this difference really, really matters, especially for business owners or entrepreneurs, because you're traditionally dealing with volatility in your company, right? Your revenue goes up and down, you have economic cycles, you have new taxes, you have staff coming and going, you have competition, like there's all sorts of things that make your business go up and down. Our clients aren't looking for more volatility generally. Adding another highly volatile component to like your personal balance sheet can actually often increase financial stress rather than reduce it. So these participating accounts can play a completely different role because it introduces a stable, predictable component into the broader financial strategy. It offsets the uncertainty that naturally exists everywhere else in the business owner's financial life. So the value isn't just the return, like how big is the dividend? It's that consistency, stability, the consistent growth and your experience over time. And I'm talking over time like 5 years, 10 years, 20 years, 40 years. We're not looking at did it go up and down in 1 year. Third thing we're going to talk about is liquidity. And especially, I'm going to say, this is funny, liquidity without liquidation. So how do you access your money without having to sell assets or without wrecking your plan? And this is one of the most overlooked advantages of participating whole life insurance policies is that liquidity that it can create without forcing you to sell other things. So in traditional portfolios that are heavy on growth, they might not have a plan for like, how do you actually get the money when you need it? And then this is where that cash value inside the participating policies becomes really important. As this policy matures, it's going to build a guaranteed cash value, and it's also going to build a dividend inside that cash value to help it grow. So the cash value creates like a lot of financial flexibility because it can be used as collateral for borrowing. And you can borrow it either from an insurance company or you can borrow from a bank. So rather than making you sell investments, which triggers tax potentially depending on the type of account you're holding in, but then you also don't have the investments because you sold it and you took the cash and spent it, right? So rather than doing that, you can use one of these participating policies to generate you the liquidity. So in practical terms, this means accessing your capital while the underlying asset remains intact. So you're not getting rid of the policy to use the money. So instead of selling something in an unfavorable market or selling something and triggering tax, or withdrawing from the corporation where again is going to trigger tax, or withdrawing from a registered portfolio. So maybe you've got money in your RRSP. If you take money out of there, taxable. You're able to borrow against these policies' cash values through either the policy loan, which is what you do with an insurance company, or a collateral loan, which you do with another, like a third-party financial institution, which is complicated speak for bank. So when you're a high-income Canadian or you've got your corporation, this type of guaranteed access to liquidity is super valuable. It allows you to get money when you need it, when it matters most, including in the worst times, including during market downturns, when selling investments would lock in losses, or when there's a credit crunch, right? So maybe people aren't handing out money at a certain time and you need it right now. It also helps with business transition. So if you're buying a company or if you're expanding or you have a cash flow gap or you need to buy a new machine or something like that, it helps with tax deadlines. So when you need cash, but you don't want to sell something, but you need to pay the tax and the CRA is coming after you and you need the money right now, being able to borrow from your insurance policy is super valuable. I do this myself personally, and we have a bunch of clients who do this as well, where your cash flow or your corporate year end or your tax year end might not line up with April, with the CRA wants their money. So you could take money from your insurance policy, pay the taxes, and then when you get your bonus in June, well, then you can replenish it, right? So it allows you that flexibility of being able to pay for things when you need to without having to break a bunch of things to get that money. It also allows you to take advantage of unexpected opportunities where your access to capital lets you act quickly when maybe other people can't. So liquidity is the key concept here. It's very simple. It's not talked about enough and it's not valued enough, I don't think, but it's so powerful because not having to sell something to get money is super powerful, especially having the ability to do it when you want and when you need. Having money invested is not the same as having access to that money, right? So true liquidity means you can get those funds no matter what, no matter when, without having to disrupt the long-term strategy, without triggering tax, or without having to sell things at the wrong time, or without having to go through an expensive selling process, right? So a lot of people in Canada have real estate. And if you needed money, you're like, well, I could just sell the real estate. Selling real estate is a pain and it's expensive. And today in 2026, it's not as easy as it was when the market was booming. There's a lot of condos sitting unsold right now and the price is just going down. But all those fees that you have to pay for selling, and your property transfer tax, your realtor fees, lawyer fees, all of these things, it's expensive to sell real estate. So that's not, you can get liquidity from it, but that's not a great place to get liquidity from. These participating policies can play a role in your financial plan by providing this stable source of collateral, by giving you the access to the liquidity, and it can help you as an investor and as a business owner keep control over the timing, the taxes, and it keeps your money in the long-term compounding. So a lot of our successful clients, the value of accessing the money is almost as valuable as the growth of the policy itself. I can speak this from experience. I do this all the time. I have multiple of these types of policies myself, and I borrow money from them all the time for different things. The fourth part that we're going to talk about is the tax advantage growth. Compounding your money is great, but when you have to pay taxes every year, you really break that compounding. A lot of the high-income clients that we work with, the biggest obstacle to the long-term wealth accumulation isn't the market performance, it's tax, right? Taxes will erode your returns year after year. And this really reduces the effectiveness of having a solid investment strategy when the CRA comes in every year and takes a chunk. In financial language, this is called tax drag. So tax drag is when your investment is taxed annually. So this interrupts the compounding process. So even if you have a portfolio and it's generating great returns, taxing it every year significantly reduces how much capital ultimately accumulates over time. And I would say that tax drag is even more important than any fees that you're going to pay, right? If you're looking online at investment advice, a lot of them are talking about, we got to reduce these fees, and they're talking about reducing the fee from 2% to 1.5%. What about reducing your taxes from 30 to 0? Like that is a way more significant thing that has a way bigger effect over your long-term financial health than 0.5s and 0.2s here and there. And now the fixed income investments that we were talking about, this really shows the problem, right? So let's talk about a bond portfolio that you could just get from any bank or insurance company or whatever. Call a bond portfolio is generating you 4 or 5% gross, which seems stable and attractive on paper. However, if you're in a higher tax bracket, the bond portfolio generates interest income, which is fully taxable as income every year. So depending on the structure of the investment, like where do you place the investment and your tax situation, a big chunk of that 4 or 5% is gone every year to taxes. And if you're going to just use rule of thumb, count like 50% of it gone if you're in the top marginal tax bracket. So over time, right, if you're doing this for decades, this recurring tax drag or tax friction will materially reduce your long-term portfolio growth, right? So you are losing money to taxes every single year here. Now, these participating policies are totally different. When you structure these participating policies properly, the cash value grows on what's called a tax-deferred basis inside the policy. So that means that you don't pay taxes on the growth until you withdraw the money, which means you're not paying taxes every single year and you allow the compounding inside the policies to grow. And a compound interest curve, if you just Google a compound interest curve, they call it the hockey stick curve, right? So it kind of goes flat and then it hits and then it goes straight up. So it takes some time during the flat, but then when it hits that inflection point, the acceleration is crazy and you want to get there. So you don't want taxes taking chunks out along the way. You want to allow the capital to grow with way less interruption from the CRA. And this gives you a way more efficient long-term accumulation. So in addition to the tax-preferred growth inside the policy, the death benefit at the end, so one day this is going to pay out, is going to pay to the beneficiaries or to your corporation tax-free. So if you have it in the corporation, it pays out to the corporation tax-free and it creates what's called a capital dividend account, right? Or it credits your existing capital dividend account. And that capital dividend account can pay out to the shareholder beneficiaries in a tax-free way when you do it right. And that's why we work with you to make sure that you do it right. The result is a much cleaner long-term compounding process because less money is lost every year to tax. A greater amount of your money stays inside the policy invested and stays inside compounding over time. So this makes a massive difference when you're talking about 20 years or 30 years or 40 years. Like this difference can be hundreds of thousands or millions of dollars. So if you're a high-income professional or you're incorporated in Canada and you care about long-term wealth preservation, the tax efficiency is almost as important as whatever the investment return is. And these types of policies can serve as a complementary component within your financial plan to help reduce the tax drag while allowing your money to compound in a controlled, predictable, safe, secure environment. Now, I said corporate ownership and I said capital dividend account a few times, so we'll talk about number 5, which is the corporate ownership and the capital dividend account. So when you're incorporated in Canada, these participating whole life policies have other advantages more than just the traditional protection, which you probably need anyways. When they're structured properly, these policies can become really like a strong and powerful planning tool that are efficient, that help you with your estate plan, that help you with long-term corporate wealth transfer. And this is why, right? So when the corporation owns the life insurance policy and the death benefit eventually pays out, that death benefit pays out to the corporation tax-free. There's an additional planning opportunity here. So this is a very unique to Canada mechanism. It's called a capital dividend account or CDA. And if you look on our channel, I've got like a bunch of videos about CDA. So the CDA is what's called a notional account. So it's not actual money, it's just written down on your accounting. It's inside the private corporation, a CCPC, a Canadian controlled private corporation, and it tracks tax-free surpluses. One of the most important sources of a CDA credit is when you receive a life insurance proceed. Another one that a lot of people know is when you have capital gains, 50% of the capital gains is taxable. The other 50% credits to your capital dividend account. So there's a few things that can credit to your capital dividend account, and you want as much credit to your capital dividend account as possible because then you can take money out tax-free from the corporation. But the life insurance death benefit pays out tax-free and credits the CDA. So the amount of that benefit or the amount of credit depends. It will credit minus whatever your adjusted cost base is on the insurance. And now this is technical. And what we would do is we would find this number. You don't need to track this yourself, but it credits to the CDA. And then that credit can go and flow out to the shareholder beneficiaries as a tax-free capital dividend. So say you have millions of dollars of life insurance that pays out to the corporation, minus whatever the adjusted cost base is, the rest of that can flow to whoever you want. It can pay debts, it can pay off the bank, it can, make your kids rich. And this really matters because getting money out of a corporation in a tax-free way is very difficult in Canada. Some ways you get money out, you get salaries or bonuses or dividends, and that creates personal income tax depending on how you've set this up with your account and depending on your marginal tax rate. But the CDA is one of the few mechanisms that lets you move corporate money to the shareholders tax-free. And if you're successful in business and you've accumulated retained earnings inside the corporation over time, this can make these corporate policies a great strategic planning tool rather than just a protection product because it lets you get those retained earnings out of the corporation in a tax-free way to their beneficiaries. Inside the broader financial plan, it can help a bunch of different objectives. So number one is estate funding. So making sure that there's money when you pass away to pay the taxes because the CRA wants to get paid when you die. Dying in Canada is one of the most expensive things that you can do if you have any sort of money. Another big advantage is in business succession planning. So providing liquidity during an ownership transition, right? So there's a few ways you can get the liquidity from the insurance policy like we've talked about. You can also generate tax-efficient shareholder distribution. So using the CDA credits to get the money from the corporation into your pocket. So in other words, the corporate policies can serve multiple roles simultaneously. So obviously, it provides life insurance protection that you need. It builds the cash value over time, and it can create a really tax-efficient way to get the money from the corporation to you or to the next generation in a tax-free way. So when you're incorporated, you've got this combination. You got the protection from the insurance, you get the liquidity from borrowing the money from the policy either through the insurance company or a bank, and you've got that tax-efficient distribution at the end, which makes this a no-brainer for the right people who have the right amount of money and who understand basically what I've talked about in this whole video. Now, obviously, there's important context to have here. This is a long-term planning tool. This is not a short-term thing. If you're thinking about doing this for 1 or 2 years and then not doing it, please just don't do it in the first place. If you're thinking about doing this for the next 40 years, great idea. Participating insurance is not designed to function as a short-term investment or as a quick financial tactic. It is a very long-term financial planning tool. It's in the name. It's called whole life insurance. You're supposed to have it for your entire life, your whole life. And it works best when it's integrated into a broader wealth strategy with the right type of person who has a long-term mindset. If you're looking for short-term gains, there's other ways to do that, and life insurance is not the way to do that. Unlike traditional market investments, so stocks, ETFs, and stuff that get evaluated on a quarter-by-quarter basis or on a day-to-day basis, these participating policies are structured to deliver value over decades. The benefits, which are the growing cash value, the liquidity, the tax-efficient transfer, these come more meaningfully the longer the policy remains in force. As these policies grow and get more efficient, they just get better. And then because of this, the success of having these participating policies and having this type of strategy really depends on how the policy is designed and how it's implemented right at the beginning. And this is where you want to work with somebody who knows what they're doing, like us. This is all we do all day, every day for the last 15 years. We're pretty good at it. A well-structured policy needs a few things. So number one, you need the proper design up front, because once you set these things up, there's certain flexibility, but there's certain things that you can't change. So making sure that it's structured properly up front to align with whatever your goals are. And especially in the case of what I've been talking about, to maximize the cash value, you have to set that up right on day one. You need to be giving it consistent funding. You want to grow the policy, you want to pay the premiums, you want to grow the cash value, you want these dividends to grow. In order to make that happen, you need to contribute to these policies over a long-term period. This is not something where you can put one deposit in today and then not touch it. This is something where you want to put these premium deposits in for a minimum of 5 years, but probably for 10. It also needs to fit within your broader financial plan. So the policy needs to complement other assets. It needs to complement your tax strategy. It needs to complement your liquidity. Without these things, it can lose a lot of the intended effectiveness. It's also important to acknowledge that these policies can pay a dividend, but I'm not allowed to guarantee you that it's going to pay a dividend in the future. Actually, no insurance company is going to guarantee you that they're going to pay a dividend in the future. But if you look historically, all the companies that we would work with, if you're working with us, have paid a dividend for more than 100 years and have never not paid a dividend. And the dividend is kind of built into the thing, but it's not guaranteed. So the dividend performance depends on a lot of factors. So number one is the investment growth inside that participating account that we talked about. So these are the investment returns. Another one that's super important and that only really matters in the insurance world and in none of the other financial world is mortality. So how does the insurance company do their underwriting and how do they estimate how many people in their pool are going to pass away this year and how much death benefit do they need to pay out? Because this is also being paid out from the participating account. They also need to keep their expenses low because somebody has to manage this, right? So there's a team, you got to pay them, they got to do the work. So you want to keep the expenses on managing the participating account low so that more of it can go towards the dividend that helps you. Also, you got to work with the right companies. Not every policy that's in the marketplace is structured optimally. Some companies we don't recommend because they don't work for what we're talking about. So having the poor policy design, not having like a strong participating account, or even on that, and that's putting the onus on the insurance company, but putting the onus on you, not having the right funding, right? So not funding these policies properly or not having clear long-term objectives can really significantly reduce the value of one of these types of contracts. And this is why this conversation around participating whole life policies is more than the simplistic question of, is whole life insurance good? Well, I don't know. It's way more productive to say something like, does this strengthen your financial plan? And does this fit with your mindset? Does this improve the long-term stability of your portfolio? Does it increase your reliable access to money or to capital without selling asset? Is it tax efficient? And does this help you across decades, especially if you're high income and you're paying a lot of tax? So these are the types of questions that we're trying to answer, and you want to answer these thoughtfully, right? And you want to answer these while having a plan. So these policies, these insurance policies can become a very valuable component of a well-designed financial strategy that's not 100% focused on growth, but it's focused on control, on the stability, on the resilience, and the growth, and the efficiency, and the access to cash, and the estate plan, and the, right? There's a lot of pieces that go into this, and there's a lot of things that it helps you do. Now, we are getting really long on this video. I can feel it. So let's have some final thoughts. Why is this viewed increasingly as a great asset class for high-income Canadians, wealthy families, and business owners? It's increasingly being positioned as more than just protection, right? So obviously you need to want the insurance in the first place if this is going to work for you. The reason that it's being used more as an asset class is it combines several of these characteristics that are rarely found all together in a single tool. So within one participating whole life policy, you have the stability, the long-term asset management, and the smoothing of returns inside the participating account. You have the diversification because the insurance company's participating fund is really a broad mix of institutional assets that could be compared to a fixed income portfolio. You have the liquidity through the cash value lending, which could either be from the insurance company itself or from a bank. You have the tax efficiency. Because it's wrapped up in insurance, you have this tax-preferred growth inside the policy, and you have the tax-free death benefit payout at the end. You get the estate certainty. You have a contract with the insurance company that this death benefit is going to pay, and then your estate use the money for whatever they want, but probably it's going to be paying for taxes. It might equalize an estate. So in Canada, having an equalization of estate is very important. It's even more important in certain provinces. And it can help you with providing a legacy to whoever you want. Generally, for our clients, it's their kids. So they want to make sure that they're leaving something for the kids. And this is a guaranteed way to do that. And it can help to support your succession planning, right? So when somebody dies, there are a lot of things to pay for. And having a life insurance check arrive within a couple of weeks helps pay for a lot of stuff. So when you put all of these characteristics together, this makes participating whole life insurance very unique inside a properly designed wealth strategy. And the role is not about maximizing returns. It's about strengthening the whole plan and especially the foundational part of the plan. So many traditional portfolios are really, they call them financial plans, but really you're buying an investment portfolio, are dependent on the market, are dependent on market performance, are dependent on timing. Like hopefully the market's doing well when you need to pull the money out. Hopefully it's not down. If the market is up, your plan looks great. But when the market is volatile or down, or when you have to pay taxes, or when you're losing money every year to taxes, or when you need liquidity at the wrong time, then your investment plan that is the only thing you're relying on can become super fragile and can break or can just not be as strong as you thought it was, right? So having one of these participating policies helps to address or offset that fragility. This introduces elements that our clients want in their portfolio. They want the predictable long-term stability. They want the access to cash, the liquidity, and they want to control that themselves. They want to save taxes, and they want to make sure their estate plan happens and that, when they pass away, the CRA doesn't take half their money, which can easily happen if you don't have a proper estate plan. So when you're a high-income Canadian or when you're a business owner and you already have the growth exposure, you have the growth inside your business, or maybe it's in real estate, or maybe you do have an investment portfolio, having this base of stability, having this base of resilience that's not tied to the market can super duper improve the durability of your overall financial plan. The goal of these policies is not to outperform the market, which is often when you look online of like why you shouldn't have a whole life insurance policy is one of the biggest arguments is that you can make more if you invest in the market. That's not the goal with these things. It's to build a plan that can survive real life. It survives ups and downs. It survives economic cycles. It survives tax changes. It survives your business transition. It survives you. It survives complicated estate. And then this is where many sophisticated financial strategies today are not focused solely on return. They're focused on reducing the fragility. I've said that word a few times now. You want the stability. You want to preserve the long-term control. You want to pay less tax. These are all important things, right? Does this work for you? I don't know. Let's see. So let's see if this can fit in your situation. So if you're an incorporated Canadian, you're a professional, you're an entrepreneur, you have a good money mindset, let's chat and see if this can even work for you. These types of strategies are definitely not for everybody, right? Like a lot of people shouldn't do this, but let's see if they can work for you. And let's see if we're a good fit. You might not even want to do it with us. You might not like us, and that's fine. The way to find out is you go to our website. It's safepacific.com. On there, you can send us a message through our contact form. There's buttons on almost every single page where you can book a meeting straight into our calendar. And then we'll go through our discovery process where we're really going to find out about your current situation, about your goals and your concerns, and about what are you trying to do. And then we'll show you policies that can or cannot achieve the goals that you're trying to do. And for us, there's no pressure, there's no rush. If you're setting up a discovery meeting, we're not making you sign anything. You're not paying for us for these meetings. We just want to know, are we a good fit to work with you? Are you a good fit to work with us? And does a strategy like this make sense? And if it doesn't make sense, we will also tell you, because we're not in the business of trying to get clients that don't fit. That's your next step. After you click the like, after you leave a comment, after you click share, after you send this to a business owner or a high income person that you know, then go to the website, safepacific.com, book a meeting time with somebody on the team, and we'll make sure that we take good care of you. That's it for me today. I'll see you next time.